You're sitting on your lunch break scrolling through Zillow again. Not because you're close, not because anything has changed since last Tuesday when you did the same thing. You do it the way people check the weather in a city they're not visiting, compulsively, pointlessly, just to confirm the reality that the numbers are still what they were. The two-bedroom in the neighborhood you grew up in is listed at $487,000. The one-bedroom in the neighborhood one train stop further is $391,000. The studio that shares a wall with a parking structure is $310,000 and has been described by the listing agent as cozy and full of character. You close the app. You open it again 11 minutes later. Here is the thing nobody says out loud at the dinner table, or in the work meeting, or in the group chat where everyone is technically doing fine. The version of adult life that was described to you. Work hard, save up, buy a place, build equity. That's how it works. That's what you do. That version requires an income that roughly 75% of working Americans do not have. Not because they made catastrophic decisions, not because they chose the wrong career, or skipped the savings account, or bought too many things they didn't need. Because the math of that version of adult life stopped working sometime around 2012. And nobody sent a memo, and everyone kept nodding along as if it still did. The affordable housing crisis is not a housing shortage story. That's what it gets called. That's the polite version. The accurate version is that it is a deliberate accumulation story. A story about who owns the asset and who pays to access it, and how completely those two groups have diverged. And the mechanics underneath it are so specific, so documented, so traceable that the only reason most people don't know them is that the people who benefit from the current arrangement have very little incentive to explain it clearly. So let's explain it clearly. In 1970, the median home price in the United States was $23,400. The median household income was $9,870. The ratio was 2.4 to 1. A median-priced home cost 2.5 years of median household income. The down payment at 20%, $4,680, took roughly 6 months of saving at a reasonable rate. This is not nostalgia. This is arithmetic. The pathway from renting to owning was not frictionless, but it was structurally accessible to a working person on a working income. In 2025, the median home price is $412,000. The median household income is $83,730. The ratio is now 4.9 to 1. The 20% down payment is $82,400. At a savings rate that accounts for rent, which now consumes an average of 30% of income before a single other expense, that down payment takes not 6 months, but 11 years to accumulate. And that is before accounting for the fact that home prices have been appreciating at roughly 5 to 7% annually, meaning the target is moving faster than most people can save toward it. You are not failing to save fast enough. The finish line is accelerating away from you. Here is where the story becomes a system rather than a coincidence. Institutional investors, private equity firms, real estate investment trusts, hedge funds, purchased approximately 1 in every 4 single-family homes sold in the United States in 2023. In Atlanta, that figure was closer to 1 in 3. In Phoenix, similar numbers. These are not mom-and-pop landlords. These are entities operating at scale with access to capital at rates unavailable to individual buyers, purchasing properties in cash, offering above asking, and then renting those properties back to the people who could not compete with a cash offer. Invitation Homes, one of the largest single-family rental companies in the country, owns approximately 80,000 houses. Not apartments, houses. The houses that were, within living memory, the entry point to homeownership for a working family. They now generate rental income from those houses at margins that require the house to never be sold back to a family, because the house is no longer a home. It is a yield-producing asset. The terminology is not incidental. When the language changes from home to asset, the entire logic of the thing changes with it. A home is somewhere you live. An asset is something you extract from. And you are the extraction. This is the business model. Not malevolent in the way a villain is malevolent. Just completely structurally indifferent to whether you ever own anything. Now here is a number that should make you stop scrolling for a second. If you are currently renting a median-priced one-bedroom apartment at $1,500 per month, which is below the current national median of $1,713, and you rent for 20 years, you will pay $360,000 into a building you will never own. At the end of 20 years, you have the right to vacate, a rental history, and zero equity. The person who owns the building has your $360,000 plus 20 years of property appreciation, which at historical rates would have approximately doubled the property's value. The ownership of the asset compounded in one direction. Your access to it compounded in zero directions. You paid for 20 years and ended up exactly where you started, except older and with less time. This is not a personal failure. This is a designed outcome. Zoning law is the mechanism most people have never heard of that explains more about the housing crisis than any other single factor. 75% of residential land in most American cities is zoned exclusively for single-family housing. Not by accident, not by tradition, by explicit legal choice, renewed consistently by city councils made up largely of existing homeowners, who understand, whether consciously or not, that the scarcity of housing supply is the engine of their primary asset's appreciation. More housing supply means lower prices. Lower prices mean their house is worth less. The incentive to keep zoning restrictive is built directly into the net worth of the people making the zoning decisions. This is the parallel universe part, and it is not actually parallel, it's just a different policy choice. Minneapolis eliminated single-family zoning entirely in 2040 and saw rents stabilize while every surrounding city continued their previous trajectory. Tokyo, a metropolitan area of 37 million people, has national zoning laws that allow dense housing construction almost anywhere, producing a housing market where a three-bedroom apartment in a desirable neighborhood costs roughly what a studio costs in San Francisco. Tokyo is not a dystopia. It is a functioning major city that made a different regulatory choice and got a different outcome. The affordable universe is not science fiction. It's a city council vote. It has been proven in multiple places. It is simply not the choice being made in the cities where most Americans are trying to afford to live. Here is what all of this feels like, stripped from the data. It feels like playing a game where the rules changed 10 years before you sat down and nobody told you. It feels like saving responsibly, doing everything correctly, watching the number in your account grow toward a goal that grows faster than the number does. It feels like the Zillow scroll, compulsive, informational, completely useless, because you already know what it says and you keep checking anyway in case the numbers have decided to make sense. It feels like explaining to your parents why you haven't bought yet and watching them try to understand the math that functioned completely differently when they were your age and is now simply something else. It feels like being told the ladder is there while watching the bottom run get raised 6 inches every time you reach for it. Here is what changes when you understand the architecture. You stop blaming yourself for the gap between where you are and where the brochure said you'd be. Not because the gap isn't real, but because the gap is structural. It was produced by policy choices, by capital accumulation patterns, by the compounding advantage of people who already owned assets when assets started appreciating rapidly. None of that is your discipline problem. And then you start asking the questions that the structure would prefer you not ask. Whether your city has a renters union or tenant protection ordinances and what your rights actually are inside them. Whether there are community land trusts in your area, nonprofit structures that permanently remove housing from the speculative market and make ownership accessible at below market prices. Whether your city council zoning decisions are on public record and when the next meeting is. Whether the co-buying arrangements that allow multiple people to purchase property together are legally viable in your state. Whether the house hacking model, buying a multi-unit property, living in one unit, renting the others, changes the math enough to make entry possible on your current income. None of these are exotic. None require wealth to investigate. They are just the questions that don't get asked when the housing crisis is framed as a shortage, instead of what it actually is, a distribution problem with identifiable causes and documented solutions that have worked in places that chose to implement them. The parallel universe with affordable housing is not running on different physics. It's running on different zoning codes, different ownership regulations, different choices about who the housing system is designed to serve. You can't rezone your city tonight, but you can stop treating the scroll as information and start treating it as the symptom it actually is. The symptom of a system that has decided, consistently over several decades, that your access to stable housing is less important than someone else's return on investment. That decision was made by people, in meetings, on the record, which means it can be unmade the same way.
The house exists. The land exists. The only thing standing between you and it is a choice that gets renewed quietly every year by people who are counting on you to keep scrolling and never look up.